My name is John Rowland, Bar Chart's Head of Trading Education. Welcome back to another episode of Rowland's Trading Roundup, where you can better learn about the features and tools that Bar Chart has to offer. If you're new here, hit the subscribe button to get alerted anytime we upload a new video. Before we jump in, please take a moment to pause the video and read this important disclaimer in full. Any decision to buy, sell, hold, or trade any investment involves risk and are best made on the advice of a qualified financial professional. Today's subject, selling cash secured puts as a discounted entry into the market. Now, since a buyer of a put has the right to sell a stock at a given strike price, the seller or writer of a put is obligated him or herself to buy that stock at that strike price. We're going to discover how to use this modestly bullish strategy to timely position ourselves with a strike price we believe represents a value or a predetermined price of a stock we want to own, in the hopes that the put is exercised, obligating us to purchase the shares and having that purchase price discounted by the amount of the put premium we collected. If the put is not exercised, we'll still get to pocket the premium. So in essence, we're attempting to purchase a stock at a price lower than today's market value. But I want to show you a trading opportunity that occurred on Monday during the broader market sell-off and that rise that we saw in the VIX. Okay, so first let me just open up Alcoa. Again, now we see a little bit different picture here. We definitely see a stock that looks like it's trending up. I was waiting for an opportunity to, get back into the stock. If I look at my opinion, right, here we see both, all three of our short, medium, and long term are all showing very strong buy indication. And under my technicals, my average true range is around $3.20, and my historical volatility is around 51, 52%. So let me open up a full chart. And, you can see that, our stock has been in a nice uptrend. And I was waiting for an opportunity to purchase this stock again. And the area where I was kind of looking at is right about here. Now, why do I like this area? Well, first of all, if we can see that we were in an area of consolidation and we broke out on a gap, and then price held. Not only that, but we see 3 green candles. That's telling me that buyers are willing to pay a higher price, right? In other words, accumulate shares, and then price shot away on another gap. So this is probably a very strong area where we should anticipate price to hold. An area of accumulation, or sometimes you might hear the word demand zone. So I was thinking that if I could sell a put that was just slightly above this area of what I believe an opportunity to buy this particular stock, that would work. And so I picked the 55 strike. If I go back to my options price and I look at what's going on today, let me just, first of all, just showing you that I have my default here is stacked side by side. You can do this and stacked on top of each other. I just kind of like it that way. Now, my 55 put strike is out of my screen, so I'm going to have to add more strikes. It's just one out. That's because Alcoa has gone up in the last few days. But here we can see our $55 put strike. Oh, excuse me, let me change. Pardon me, I'm going to change to my monthly. And it's currently today, it's trading around $1.35, $1.40. Now, let's go back in history and see what happened on Monday. And here it is, January 24th. You can see that the $55 put opened up around $4.70. Now, by the end of the day, it did finish around $2.69, but $4.70. Now let's go back to our options overview and see what was going on with our implied volatilities and our ranks and our put call volume. And here it is on the 24th, right? And implied volatility was at 63, 64%. Remember, historical was around 51, so we are seeing an inflated implied volatility. Now, my rank is not at the high end, that top third, but I will tell you that on the day this happened, this is the settlements implied volatilities from the 21st, but in the morning, we were definitely in the 70s in terms of our ranks, and our percentile was in the high 90s. But here's the value that I really want to kind of point out to you. Notice that our put call volume is very high to the put side. And if you look at what Alcoa has been doing for, let's say, the last month, we look at our put call volume, we can see that this has been a bullish stock, that we're seeing a lot more call volume than put volume. But on this particular day, a lot of put action. That's telling me that the puts are inflated. So let's go back to our stock price. Whoops, let me go here. So here's our $55 strike. And where is that value where I'm just going to say, hey, you know what? I don't feel comfortable owning this stock. Where am I going to set my stop? Where do I assess risk? Well, it would probably be right below this little island of accumulation. And if I raised up my line here just a little bit, you know, I'm getting closer to $51. Well, that's telling me that if I could have sold this put at and captured at least $4 worth of premium, then I would have a nice positioned break-even point. What was the other thing that we talked about? Well, here we see it structurally break-even value based on our candlesticks, a recent pivot low, swing low. But let's look and see how this does with our other technical analysis, just a simple technical analysis, our moving averages. And again, let me shorten up the time frame a little bit for you. And again, the red line is our 20, the blue line is our 50, and the purple line here is our 100. So the top of my little island here is right at my 50-day. And the bottom of my island is below my 100-day. So technical support based on our moving averages, that gives me more confidence that this is a good buying area. Now, unfortunately, well, actually fortunately for me, is that, you know, the stock price has shot back up, and I didn't get the opportunity to get exercise and to take ownership of this particular stock. So some of you will say, well, you know, your strategy didn't really work. Well, yeah, in the case of the naked put discounting aspect of being exercised, yes, it didn't work. But again, if I go back and look at my, excuse me, let me just go here. I think it's still up. If I go look at my options prices, and we showed you this in the first part of this segment, that put that I would have sold, that $55 put of a value of at least $4, that's kind of what I wanted to get, right? Today is, again, let's not stack these side by side. And I'm probably going to need to add just one more strike. Today, that $55 put is only worth $1.45, $1.30. So think about that in terms of, let's say we sold somewhere between $4 and $4.50. Well, we're picking up between $2.50 and $3 worth of profit. So yeah, I didn't get the opportunity to get exercise and take this trade, but I've now collected some premium. And I want you to think about this in terms of I've really created a coupon. And I don't know when I'm going to get another opportunity to buy Alcoa. I think in terms of my chart, I might get another dip. I don't know. I could let this put go to expiration and collect that total premium that's somewhere between $4 and $4 or above and create a $4 coupon. The next time I might buy Alcoa might be when it breaks above this high, $65. But I have a $4 coupon. And so really I'm going to be buying Alcoa at $61. So this is a way we can use the naked put strategy to create credits or coupons in case we don't get that opportunity to take a possession of that stock, in other words, being exercised. And, you know, over a lifetime of trading this stock, I have so many coupons saved up trading Alcoa that I'm actually at the buy one, get one free stage. All right, so that's kind of the process that I want you to walk through when you start using the naked puts strategy. I hope this video was informative. If you enjoyed today's content, make sure you subscribe to our channel and give this video a thumbs up. Until next time, the good of all trading.